Hi, I'm Patu from freefincal. Let's take a look at DSP Nifty top 10 equal weight index fund and ETF, which are probably in their NFO period right now. So these funds will invest in this Nifty top 10 equal weight index. That means that they will take the top 10 stocks of Nifty and approximately distribute money equally. Not exactly, but approximately. Now, it seems like a good idea on the face of it. Of course, uh, that is true of all NFOs. If you dig deeper, things will be different. Um, After all, if you take the Nifty 50, about 55% weightage comes from just the top 10 stocks. So one can ask, why do I need 50 stocks? I might as well invest just in the top 10. Of course, they want to invest in the top 10 in equal weight. That's a different matter. So of course you would expect this to be a little more volatile, but you would say maybe it will give you a little more reward for that extra risk that you take. So let's see what happens. So since inception, so you have data from middle of or early 2006 if I'm not wrong, and if you compare the Nifty top 10 equal weight index in blue versus Nifty 50 in orange, you can, if you look at this and don't look carefully, it looks as if it's a great idea to invest in the top 10 equal weight index, but for the first 6 years it had underperformed. If it had underperformed for the first 6 years, that means that kind of underperformance can occur again in future, particularly after we invest. So if you look at the first 6 years, you can see that it has not done well. So how can you say that investing only in the top 10 stocks and that too in equal weight will always give you a better reward? Of course, no one is saying that, but I'm just saying if you want to invest in it, you expect better reward and you expect better reward all the time. So you can't expect that, and that's precisely what I want to point out. Now, this is a screenshot of a slide from the AMC's presentation deck, and they have compared S&P 500 top 10 index, that's in cyan colored, and S&P 500 index in blue, and they say that the investing in the top 10 this is the statement they made: top 10 stocks from S&P 500 have beaten S&P 500 index over long term in US. But is that really true? Look at the period from July 2005 all the way to just before the COVID crash. The top 10 index has not outperformed the S&P 500. That's true, pretty long term, and there it has not outperformed. So this top 10 stocks outperforming seems like a recent phenomena, post COVID. At least in the US, it looks like post COVID, and in India, it looks like it probably after from 2014 onwards. That's been the kind of trend. At least if you look at it from inception, if you look at rolling returns, you'll get a different picture. So it is not an idea that will consistently outperform. That is true for every idea. No idea will consistently outperform. And most people, when they look at all these pictures, they assume that it's a terrific thing and buy. But once they buy and put in money, and once the idea does not pan out, then they'll start complaining. So that's just not right. So these are rolling returns, very little data points, but for what it's worth, these are the rolling returns over 5 years. Over 5 years, the white line is the top 10 equal weight. It's not significantly high compared to the red line, because you have to take into account tracking error, you have to take into account AMC fees and so on. Because this is a smart beta index, the AMC could have higher fees. They may, I don't know. So you have to take that all into account. Over 10 years, yes, the top 10 has equal weight has outperformed, but if you notice, there are periods in which it has not, and there are periods in which the outperformance is large and then it falls down and then it becomes large again, and then in the last couple of months or so it has fallen down again. So again, over 10 years also it is not consistent, and this is not really 10-year data. Of course, this is 10-year rolling returns, but if you actually look at the window in the x-axis, this is less than 10 years. This is only from around 2005 to 2024. So that's 2015 to 2024, excuse me. So that's less than 10 years. So you're looking at 10-year data over a less than 10-year window. So that's not much of data points at all. And even within this data point, you can see the trend that idea is not performing well all the time. So there's no compelling reason for you to invest in the top 10 equal weight index. Just stick to Nifty 50 or Sensex. Bye bye.